Have you ever found yourself, maybe late at night, looking at your tax stuff and thinking, okay, wait, can I claim my kid who's in college? They had that summer job. Or what about my mom? She lives on her own. Or, my partner. We live together, but we're not married.
Yeah, these are super common questions. We hear them all the time.
Absolutely. And finding the right answers, well, it can actually mean real tax savings, benefits you might be leaving on the table. So that's why today we're doing a deep dive into this whole world of claiming dependents.
It can seem complicated.
It really can.
Yeah.
Our goal here is simple. Cut through the IRS jargon, explain the big difference between a qualifying child and a qualifying relative, and give you some clear, actionable info.
Exactly, because getting this right helps you spot those tax benefits.
And it's so timely, isn't it? Because the rules, they keep shifting.
They do. And it's important to note, while the big old personal exemption for dependents, that deduction, it was suspended by the Tax Cuts and Jobs Act for 2018 through 2025. But, and this is key, being able to claim someone as a dependent still unlocks a whole bunch of other valuable tax credits and deductions.
Ah, okay. So it's not gone. It's just changed form, in a way.
Precisely. Knowing the rules is just as crucial now, maybe even more so, for maximizing, your overall financial situation.
Okay, so it's not just the old exemption. It's about these other benefits. Got it. So let's jump right in then. The IRS splits dependents into two main types.
That's correct. You've got the qualifying child and the qualifying relative.
And the names sound straightforward, but I suspect there's more to it.
Oh, definitely. Each one has its own specific set of tests you have to meet, and usually if you meet the test for one, you can't beat the other.
Like separate clubs with different entry rules.
That's a great way to put it. And knowing which club someone belongs in is vital.
Why is that so important?
Because the classification tells you which tax benefits you might get. And generally, the qualifying child classification tends to open the door to more significant benefits, like the child tax credit, for instance.
Okay, that makes sense. So let's unpack that first club then. The qualifying child. You mentioned tests. How many are there?
There are 5 key tests, and you have to meet every single one. No skipping allowed.
All right, lay them on us. What's the first one?
First up is the relationship test. Basically, who counts? It's your son, daughter, stepchild, eligible foster child, or a descendant of any of them, like your grandchild.
Okay.
It also includes your brother, sister, half-brother, half-sister, stepbrother, stepsister, or a child of any of them, like a niece or nephew.
So pretty close family ties.
Right. And a really important point. An adopted child is treated exactly the same as a biological child for all tax purposes.
Good to know. What about age? I asked about my college kid earlier.
Yes, the age test. This trips people up sometimes. Generally, the child has to be under age 19 at the end of the tax year.
Under 19?
Or if they're a full-time student, that limit goes up to under age 24.
Okay, that's the key for college students.
Exactly. But they also have to be younger than you, or your spouse if you're filing jointly. Now, there's a big exception. If the child is permanently and totally disabled at any time during the year, there's no age limit at all.
Okay, so my 23-year-old full-time student probably qualifies on age.
Likely, yes.
But if they turn 25, even if they're still a student, they're probably out.
Usually, yes, unless they meet that disability exception. And one more detail on full-time student.
Right.
It means they were enrolled for what the school considers full-time for at least 5 calendar months during the year. Doesn't have to be consecutive months, but 5 total.
Gotcha. So a light semester might not count. Okay, test number 3.
That would be the residency test. The child must have lived with you for more than half of the year.
More than half the year. What about temporary absences, like college?
Right. Those generally don't count against you. Things like illness, education, college dorms are a classic example. Vacation, military service, even time in juvenile detention. Those are considered temporary. Also, if a child was born during the year, or sadly passed away, they're treated as meeting the test if they lived with you for more than half the time they were alive that year.
That makes sense. Okay, relationship, age, residency. What's next? Must be about money.
You guessed it. The support test. This one's crucial. The child cannot have provided more than half of their own support for the year.
Their own support, so if they have a job.
Exactly. You need to look at their total support costs. Think food, housing, clothes, education costs, medical, recreation, transportation, all of it.
Okay.
Then figure out how much of that they paid for using their own money versus how much you or others paid. a really helpful point here. Scholarships they receive for school generally do not count as the student providing their own support.
That was huge.
It is. But money they earn from, say, a summer job and then spend on their own clothes, car, or tuition, that does count as them supporting themselves. If that amount crosses the 50% line of their total support costs, you can't claim them as a qualifying child.
Wow, okay. So you really need to track that if your kid earns decent money. All right, one test left for the qualifying child.
Yes, the last one is the joint return test. The child generally cannot file a joint tax return with someone else for that year.
Generally. Is there an exception?
There is a very specific one. If the child and their spouse file a joint return only to claim a refund of income tax withheld or estimated taxes paid, then it's okay. But if they file jointly to actually owe tax or to claim a tax credit themselves, then you usually can't claim that child as your dependent.
Okay, that's pretty clear cut. So those are the 5 hurdles for a qualifying child. Relationship, age, residency, support, and joint return.
Exactly. Meet all 5 and they're your qualifying child.
But like we said, what if someone doesn't fit that? Maybe it's your parent you help support, or that partner scenario again. That's where the other category comes in.
Precisely, the qualifying relative. And this is where, as you said, the name can be a bit, well, misleading.
How so?
Because it's not just relatives. But first things first, there's a prerequisite test.
Okay.
It's the not a qualifying child test. Basically, the person you want to claim as a qualifying relative cannot be your qualifying child, and they can't be the qualifying child of anyone else either.
So the qualifying child status takes precedence. If they qualify as a child for any taxpayer, they can't be a qualifying relative for you.
You got it. It's a hierarchy. Child first.
Okay. So assuming they're not someone's qualifying child, what makes them a qualifying relative?
This is where we get some flexibility with the relationship or member of household test. They have to meet one of 2 conditions. Condition 1. They have to be related to you in one of the ways listed by the IRS. This includes your parents, grandparents, step-parents, your siblings, aunts, uncles, nieces, nephews, and also your in-laws, mother, father, son, daughter, brother, sister-in-law.
A pretty wide net of relatives.
It is. And here's a key difference. These listed relatives do not have to live with you to pass this particular test.
Really? So I could potentially claim my dad who lives across the country if I meet the other tests?
Exactly. As long as he's your father, he meets the relationship part of this test without living with you.
Okay, that's huge. What's the second condition if they're not one of those listed relatives?
Condition 2 is the member of household rule. If they aren't one of those specified relatives, they must have lived with you as a member of your household for the entire calendar year.
The entire year. You emphasized that before.
Yes, January 1st to December 31st. This is how an unrelated person, like a boyfriend, girlfriend, or even just a friend you're supporting, could potentially qualify. But that full year residency is strict. 11 months and 2 weeks. Nope.
Wow, no wiggle room there.
Yeah.
Okay, so they meet one of those 2 conditions. What else?
Next is the gross income test. This is a hard ceiling. The person's gross income for the year must be less than a specific amount set by the IRS. For 2024, that amount is $5,050.
Less than $5,050 in gross income. What counts as gross income?
Pretty much any taxable income wages, self-employment earnings, interest, dividends, taxable unemployment benefits. One common question is about Social Security. Generally, Social Security benefits are not counted towards this limit unless the person has enough other income that makes part of their Social Security taxable.
Okay, that's important. So low income is key here. What's the final test?
It's the support test again, but it's flipped from the qualifying child rule. For a qualifying relative, you must have provided more than half of their total support for the year.
So I have to provide more than 50% of their living expenses.
Correct. You need to calculate their total support costs for the year again, food, lodging, clothes, medical, etc., and then determine if the amount you contributed was more than half of that total.
How does lodging work if they live with me?
You'd include the fair rental value of the room or home you provide, then add in the cost of food, utilities, medical expenses you paid, and so on. Compare your contribution to their total support costs, including any money they spent from their own savings or income, or support they got from others.
So if my mom lives with me rent-free, and I buy all the groceries, but she uses, say, $6,000 from her savings for medical bills and clothes, and my contribution only adds up to $5,000, I might not meet the test.
That's exactly right. Even if she meets the income test, if her own funds covered more than half her support, you couldn't claim her. Keeping good records is really important here.
Definitely. Okay, so we have the two categories, qualifying child and qualifying relative, and their distinct tests. Let's bring this home. What does this mean in practical terms? Let's tackle those common scenarios. Boyfriend or girlfriend, can you claim them?
You potentially can, yes, but only as a qualifying relative.
Okay.
Which means they absolutely must have lived with you the entire year. Their gross income must be below that $5,050 threshold for 2024, and you must have provided more than half their support. And of course, they can't be anyone else's qualifying child.
Got it. Entire year, low income, you pay more than half. What about parents?
Yes, parents are a very common scenario. They can be claimed as qualifying relatives. And remember, because they're your parents, they don't have to live with you.
Right, that was the big point.
As long as their gross income is below the limit and you provide more than half their support, you can likely claim them.
Okay, so that covers who you can claim. Now the big question, why claim them? What are the actual tax benefits these days now that the exemption is gone?
Great question. The most direct benefit, especially for qualifying relatives, is often the credit for other dependents, or ODC. It's worth up to $500 per qualifying dependent.
And that's a credit, right, dollar for dollar tax reduction.
Exactly. It directly reduces the tax you owe. Very valuable.
Nice. What else?
You might qualify for the Child Independent Care Credit. This applies if you pay someone to care for your dependent, maybe an aging parent or a disabled relative who can't care for themselves, so that you can work or look for work.
Okay, helps offset care costs.
Correct. Also, if you itemize your deductions instead of taking the standard deduction, you might be able to include medical expenses you paid for your dependents in the medical expense deduction.
How does that work again?
You can deduct the amount of unreimbursed medical and dental expenses for yourself, your spouse, and your dependents that exceeds 7.5% of your adjusted gross income, your AGI.
So if my AGI is, say, $80,000, I can deduct the medical expenses I paid for my dependent mom that are over $6,000, which is 7.5% of 80K.
Precisely. If you paid $8,000 of her medical bills, you could potentially deduct $2,000.
Okay, that could add up if there are significant medical costs.
Yeah.
Any other big ones?
Yes, a potentially major one. Claiming a dependent might allow you to file using the head of household filing status.
And that's generally better than filing as single, right?
Much better, usually. It gives you a higher standard deduction and typically lower tax rates than single or married filing separately. To qualify, you generally need to be unmarried and pay more than half the cost of keeping up a home for yourself and a qualifying person.
And that qualifying person can be a qualifying child or a qualifying relative.
Yes, and here's that key point about parents again. If the qualifying person is your parent, whom you can claim as a dependent, they don't have to live with you for you to qualify for head of household status.
Wow, that's huge. But for other qualifying relatives, like that boyfriend or girlfriend?
For most other qualifying relatives, they do have to live with you for more than half the year and meet other tests for you to use them to qualify for head of household. So parents get special treatment there.
Good to know. Now, sometimes support isn't just one person. What if, say, several siblings are chipping in to support a parent?
Ah, yes, the multiple support agreement. This happens a lot. If no single person provides more than half the support, but a group of people together provide more than half. And each person in that group could have claimed the dependent if they had provided more than half the support.
Right.
Then the group can agree that one of them, who provided more than 10% of the support, will claim the dependent.
So one person gets the claim, even if they didn't hit 50%.
Correct. But the others in the group, who also provided more than 10%, have to sign a written declaration, Form 2120, stating they won't claim that person for that year.
So say 3 kids each give 30% support for mom. Total 90%. None hit 50%.
Exactly. One of them can claim mom as long as the other 2 sign the form saying they won't. It prevents the benefit from being lost just because the support is shared.
That's a really practical rule. What about divorced or separated parents? That's always complex. Who gets to claim the child?
It definitely can be. The general IRS rule focuses on custody. The custodial parent, the one the child lived with for more nights during the year, typically gets to claim the child for tax purposes, including things like the child tax credit and head of household status.
Okay, based on nights.
Right. However, the custodial parent can choose to release their claim to the dependency exemption, which relates to the child tax credit and credit for other dependents, to the non-custodial parent.
How do they do that?
They have to sign Form 8332, Release Revocation of Release of Claim to Exemption for Child by Custodial Parent. The non-custodial parent attaches this form to their tax return.
So the non-custodial parent can claim the child tax credit if the custodial parent agrees.
Yes, but, and this is critical, even with Form 8332, the non-custodial parent cannot claim head of household filing status, the earned income tax credit, or the child and dependent care credit based on that child. Those specific benefits always stay with the custodial parent, generally.
Wow, okay, so Form 8332 only transfers certain benefits. That's a really important distinction.
It is, and if there are disputes or confusion, the IRS has tiebreaker rules, which usually favor the parent the child lived with longer, or the parent with the higher AGI if the time was equal.
Man, these rules have layers, don't they? They seem complex, but like you said, figuring them out can genuinely lead to tax savings. It feels less like just following rules and more like, well, smart financial planning.
That's a perfect way to look at it. It's about understanding the system to make sure you're getting the benefits you're entitled to.
So if people listening have more questions about their own, maybe unique situation.
Well, the IRS website, irs.gov, is honestly a fantastic resource. They have tools like the Interactive Tax Assistant that can guide you, plus detailed guides like Publication 501, dependents, standard deduction, and filing information.
Good starting points.
Definitely. Good tax software also walks you through these questions pretty effectively. But, if your situation feels complicated or you're just not sure, talking to a qualified tax professional is always a solid investment.
Right. Get personalized advice.
Absolutely, because sometimes one small detail can change the outcome. You need to be precise with these rules.
It really drives home that staying informed, especially as tax laws can change, is just powerful. It helps you manage your whole financial picture better.
Couldn't agree more.
Well, thank you for walking us through all that. It was a really helpful deep dive into dependents and the tax benefits they can unlock.
My pleasure. It's important stuff.
Indeed. We'll be back soon with another dive into a fascinating tax topic to keep you informed. Until then, everyone, keep digging for those nuggets of knowledge.